So, if I told you a major American fast food chain just lost almost 8% of its domestic customer base in a single quarter.
Which is just a massive drop.
Right, huge. And that they suffered a double-digit collapse in operational profitability and, was currently watching its franchisees basically fight to survive on these dangerously thin margins.
You would probably expect their stock to just be in an absolute free fall.
Exactly. You'd expect management to be issuing emergency revisions, basically begging Wall Street for patience.
Oh, absolutely.
But Wendy's management just looked analysts in the eye on their Q1 2026 earnings call and effectively said, don't worry, everything is right on schedule.
Yeah, it is one of the most fascinating disconnects between trailing data and forward guidance that we've seen in the quick service restaurant space this entire year.
Welcome to this special Talk Tickers format deep dive. Today, the mission is simple. We are going to cut through the corporate jargon, deliver the hard data, and give you an actionable breakdown of Wendy's ticker symbol WEN.
We're looking at their Q1 2026 earnings call.
And we are doing it at a rapid-fire pace that respects your time. So whether you are holding WEN stock right now or you're just watching the fast food space to gauge the health of the consumer, this deep dive is for you.
Yeah, we really need to figure out if Wendy's is serving up a fresh turnaround or if their financials are currently just sitting in the deep fryer.
I mean, the stakes here are incredibly high. You have a legacy brand trying to pivot its entire operational model while under severe inflationary fire.
Right. And you have trailing indicators flashing bright red across their domestic footprint. But management is projecting this miraculous, almost frictionless recovery in the second half of the year.
So let's jump right into section 1, the headline numbers. The divergence really starts right at the top of the income statement.
It does, because if an algorithmic trading bot just scrapes the headline revenue number, it actually sees a slight beat.
Right. Total adjusted revenue actually ticked up by $9.2 million.
Landing at $432.3 million for the quarter.
With adjusted earnings per share sitting at 12 cents. So on paper, that top line growth suggests a business that is, well, at least treading water.
Maybe even expanding its footprint successfully, right?
But, and this is crucial for you as an investor to understand, top-line revenue growth in the restaurant sector can be an incredibly dangerous illusion.
Oh, absolutely.
Yeah.
Total revenue goes up simply because they open new stores.
Exactly. I mean, a newly poured concrete foundation and a freshly lit drive-through sign will naturally generate new cash flow. But that top-line beat is masking a severe underlying contraction.
Yeah, when you strip away the new real estate and look at adjusted EBITDA, it's a completely different story.
Let's translate that real quick. Adjusted EBITDA is basically the actual operational cash flow of the business before the accountants get involved.
Right, the raw money-making engine. And that engine saw a 13.2% plunge down to $111.3 million.
That is not a minor stumble. A double-digit drop in EBITDA year over year means there is a structural compression in how this company makes money.
And the culprit for that compression is glaring. U.S. same-restaurant sales plummeted by a brutal 7.8%.
Okay, wait, let's pause on same restaurant sales. This is the metric that strips out the noise of new development, right?
Exactly. It isolates the mature existing locations. It asks one very simple question. Are the customers who came here last year actually coming back today?
And a near 8% drop means the answer is a resounding no.
No, they are not. And because the United States represents the overwhelming majority of Wendy's revenue, that domestic anchor dragged global system-wide sales down by 5.5%.
Which just sounds catastrophic. I mean, losing nearly 8% of your comparable sales in a single quarter for a brand with universal awareness. Wendy's isn't some new concept trying to find an audience.
Right, their logo is visible from like half the interstate highways in America.
Exactly. So when 8% of the revenue walks out the door of a mature location, we aren't just looking at a few missing orders. We are looking at a fundamental rejection by the consumer.
But management, of course, had a narrative ready for this.
Naturally. And let me guess, the weather.
Spot on. They pointed to severe winter weather in January and February. They claimed it shaved off a full percentage point from those U.S. comparable sales.
Right. They highlighted January comps dropping roughly 8% and February deteriorating into the high 8% range.
Yeah. The executive team leaned heavily on the barometer, basically suggesting that blizzards and ice storms artificially suppressed foot traffic.
Specifically across their core Midwestern and Northeastern markets. But I have to push back here. I am calling out the weather defense.
It's a classic excuse.
Every Q1 earnings call in the retail sector leans on meteorology when the numbers are bad. But McDonald's, Burger King, and Taco Bell operate in the exact same physical climate.
Right, a blizzard in Ohio affects the Golden Arches just as much as it affects Wendy's.
Exactly. Yes, severe weather suppresses temporary demand, but it does not cause a sustained 8% cratering across a 3-month period unless the underlying consumer demand is already incredibly fragile.
Well, and the data management provided actually undermines their own weather narrative.
Oh, how so?
Because when the skies cleared in March and April, U.S. comps were still down 6.2% and 6.4% respectively.
Wow, so the weather might have exacerbated the bleeding, but the patient was already hemorrhaging.
Exactly. Which brings us to section 2, the story behind the numbers. The real friction isn't atmospheric. It is a combination of their own internal turnaround strategy and a brutal reality check within their supply chain.
Let's talk about the supply chain, because even if we assume foot traffic was perfectly flat, the unit economics of the burgers they did manage to sell were severely compromised.
Yeah, U.S. company-operated margins collapsed to 11.4%.
11.4. The issue isn't just that fewer people are pulling up to the window, it's that every single item handed through that window is suddenly bleeding profitability.
It is a textbook margin squeeze. You have an 8% spike in commodity costs, fueled almost entirely by double-digit inflation in beef prices.
And this exposes a massive vulnerability in Wendy's core brand identity. I mean, for decades, their primary competitive moat against McDonald's has been that slogan.
Fresh, never frozen beef.
Right. From a marketing perspective, it implies superior quality. It commands a premium. But from a supply chain perspective,
it is a logistical tightrope. It leaves them highly exposed to spot market volatility.
Exactly. When you commit to fresh beef, you forfeit the ability to hedge using deep freeze warehousing.
Right. You cannot buy massive tranches of frozen patties when cattle prices dip and just store them for a year.
You are forced to purchase constantly at current market rates to ensure the product arrives before spoiling. So when the national cattle herd shrinks and wholesale beef prices spike,
Wendy's absorbs that pain instantly. They cannot wait out the market.
The fresh beef promise requires this highly localized, high-velocity distribution network. Trucks have to move faster, refrigeration has to be perfect.
And the spoilage risk is exponentially higher than a frozen patty that can sit in a walk-in freezer for 6 months.
Right. So you combine that fragile supply chain with a 4% inflation rate in labor costs, and the unit economics deteriorates so fast.
Ingredients cost 8% more. The employees assembling those ingredients cost 4% more.
And the overall volume of customers dropping by nearly 8%. It is a mathematical cocktail that guarantees margin destruction.
But what makes this quarter particularly complex is that management is actively self-inflicting a portion of this revenue pain.
Wait, intentional revenue pain. Are you talking about Project Fresh?
Yes, Project Fresh. It is an aggressive, systemic pruning of the business.
Ah, right. They are working with franchisees to shut down structurally unprofitable locations and drastically alter operating hours.
Specifically, they are cutting back on the early morning breakfast day part where labor costs are just totally outstripping sales.
Yeah, breakfast was explicitly called out as their worst performing day part. It created a drag of over 100 basis points on U.S. sales.
Fast food breakfast is a highly habitual occasion. Breaking a consumer's routine to pull them away from a McDonald's Egg McMuffin or a Starbucks coffee is notoriously difficult.
It requires massive marketing spend.
Right. And Wendy's management recognized that bleeding cash in the morning to chase unprofitable market share was just unsustainable.
So they are pulling back those hours and redirecting resources to late-night operations where margins are naturally higher.
Exactly. They are protecting the bottom line at the expense of the top line.
But management admitted this system optimization will create a deliberate $15 to $20 million revenue headwind for the full year.
Yeah, they are intentionally taking cash off the table today to cauterize the wound.
But here's the thing. An intentional contraction still requires exceptional execution on the remaining operations. If you are going to serve fewer customers, the experience for the ones who do show up has to be flawless.
And this is where we need to look at the micrometrics, the granular operational data that dictates the actual customer experience.
Because while the macro numbers look grim, the ground level execution under Project Fresh is actually showing quantifiable improvements.
Yeah, they rolled out a new white glove cleaning initiative. They deployed field teams to enforce rigorous, standardized cleanliness protocols.
And the result was a 160 basis point jump in customer cleanliness scores.
Which is huge. Moving a subjective customer satisfaction metric by 1.6% across a decentralized network of 6,000 restaurants in a single quarter is an immense lift.
It requires changing the daily habits of thousands of shift managers and teenage employees. But you know what operational tweak struck me the most?
Was it the label printers?
Yes, the deployment of menu item label printers.
It sounds so trivial, doesn't it?
Right. They scaled the use of custom label printers from less than half their system to over 85% of their restaurants. In the context of a multi-billion-dollar publicly traded corporation, a sticker printer sounds absurd to highlight.
But in the architecture of a drive-thru, it is a critical friction removal tool.
Completely. Think about the drive-thru experience. It is an exercise in extreme throughput and implicit trust. If a family orders 3 custom burgers, one with no mayo, one with extra pickles, one plain,
And the employee hands over a bag containing 3 identical foil wrappers.
the customer experiences immediate anxiety. They have to pull over, unwrap the food, inspect the condiments, and inevitably ruin the presentation.
The food cools down, they get frustrated, and the perceived quality plummets before they even take a bite.
Exactly. By simply slapping a printed, highly legible sticker on the wrapper that explicitly details the customization, Wendy's increased order accuracy scores by 170 basis points.
Removing that anxiety builds institutional trust. If a consumer trusts that the bag handed through the window is 100% accurate, they are significantly more likely to return.
And management provided data proving that these basic blocking and tackling operational improvements actually generate tangible revenue.
Yeah, they're company-operated restaurants. The locations where corporate has direct control over training outperform the broader independent franchisee system by 310 basis points.
Furthermore, the locations ranking in the highest tier of customer satisfaction are outperforming the lowest tier locations by a massive 400 to 500 basis points in sales.
So the thesis of Project Fresh is sound. Serve hot food accurately in a clean building, and sales will eventually follow.
The problem is the velocity of the turnaround versus the patience of the market. Fixing label printers in Ohio is a slow, grinding process.
Sure.
But while they are battling domestic margin compression, they dropped an absolute bombshell regarding their international footprint.
The international segment was the lone bright spot, posting 6% system-wide sales growth.
And that lifeboat isn't just floating, it's being retrofitted into a battleship.
Oh, absolutely. The true catalyst was the announcement of the largest development agreement in the history of the Wendy's company.
They signed a master franchise agreement to build up to 1,000 new restaurants across China over the next 10 years.
1,000 stores in a decade.
That is an aggressive, sustained capital deployment into arguably the most complex and competitive quick-service restaurant market on the planet.
Yeah, KFC and McDonald's have spent decades building impenetrable supply chain moats in China.
KFC in particular isn't just a fast food joint there. It's an ingrained part of the culture with a menu entirely tailored to regional palates.
So Wendy's is arriving incredibly late to this massive demographic party.
And being a late entrant in China requires a very specific playbook. You can't simply drop an American menu into a Tier 2 Chinese city and expect instant adoption.
No, you can't. The local operator they partnered with, though unnamed on the call, is described as having decades of regional expertise.
That partner will bear the brunt of the real estate acquisition, local supply chain logistics, and menu localization.
And their strategy relies heavily on their new Future Fresh restaurant design,
which emphasizes smaller footprints, digital kiosk ordering, and high-volume delivery integration.
Exactly, which is absolutely vital for the Chinese urban consumer market.
But the geopolitical timeline here is the real wild card. Promising 1,000 stores over 10 years is a fantastic headline, but 10 years is an eternity in global economics.
Oh, for sure. Trade tensions, local regulatory shifts, changing consumer habits, any of that can derail a master franchise agreement overnight.
More importantly for investors right now, the promise of 1,000 stores in Asia in 2036 does absolutely nothing to fix the fact that U.S. margins are sitting at 11.4% today.
And that tension brings us to Section 3 management's forward-looking guidance.
This was the most perplexing segment of the entire earnings call.
Because despite the massive domestic contraction, despite the soaring cost of fresh beef, and the deliberate revenue headwinds of closing unprofitable hours,
management stubbornly held the line.
They reaffirmed their full-year 2026 outlook,
projecting flat global system-wide sales. keeping adjusted EBITDA guidance at $460 to $480 million.
And maintaining EPS at 56 to 60 cents.
The mathematical gymnastics required to achieve that guidance border on the impossible.
Yeah, let's break that down. Q1 global sales contracted by 5.5%.
Right. And management explicitly stated on the call that they expect Q2 sales to remain depressed. They forecast a decline in the mid-single digits. Let's just assume a 5% drop.
Okay, so if you spend the first half of the fiscal year shrinking by 5%, getting to a net zero flat by December requires a miraculous violent upward trajectory in Q3 and Q4.
It's like a football team being down 3 touchdowns at halftime, but guaranteeing the fans they'll still tie the game.
Wall Street analysts zeroed in on this immediately.
I bet. An analyst from Evercore effectively asked the management team what specific mechanisms give them the confidence to project a sudden hockey stick recovery.
Especially when current macroeconomic indicators show a consumer base that is actively retreating.
Exactly. It's just basic physics. If you dig a 10-foot hole over 6 months, you cannot build a 20-foot tower in the next 6 months using only the dirt you dig out tomorrow.
No, you can't.
The mathematical velocity required in the second half of the year doesn't just need a return to baseline growth. It requires a systemic behavioral shift in the American consumer that just isn't present in any current macro data.
But management does have a blueprint for this recovery. It rests on 4 distinct compounding pillars.
All right, let's hear the pillars. What is pillar number 1?
A drastic overhaul of their marketing apparatus. After 18 years with the same media agency, they fired them.
Wow, 18 years?
Yeah. They are onboarding a new partner who will take full control of the advertising spend in the third quarter.
Management claims this transition will unlock a highly sophisticated, audience-based digital approach that drastically improves return on ad spend.
But changing a media agency of record after nearly 2 decades is a tectonic operational shift.
It implies that the previous team simply lost the cultural pulse. But look, targeting an audience with hyper-efficient digital ads doesn't change the underlying reality of that audience's bank account.
Exactly. An algorithmically perfect Instagram ad cannot force a consumer to spend money they don't have.
Which leads us to the second pillar, the Biggie Deals platform. This is the true battlefield for this turnaround.
Launched in January, this is a permanent tiered value menu priced at $4, $6, and $8.
Because they had to abandon the strategy of relying on premium-priced, limited-time promotional items, the lower-income consumer simply abandoned them.
Inflation, exhausted savings, and high interest rates have severely squeezed the working-class demographic.
So Wendy's is implementing a barbell pricing strategy to prevent total customer defection. The mechanics of the $8 Biggie bundle are just fascinating to me because it looks like a desperate loss leader strategy.
Yeah, for $8, the customer receives 2 double stacks, fries, and a drink.
The CEO proudly highlighted that this bundle delivers 46 grams of protein, offering 46 grams of fresh, never frozen beef for $8 in an environment where beef inflation is in the double digits.
It is an aggressive attempt to buy back market share at the direct expense of margin.
Right. It's an admission that the lower-income consumer is actively trading down to grocery store prepared meals or cheaper competitors. And Wendy's is willing to sacrifice profitability just to keep cars in the drive-through lane.
The huge risk with the Biggie Deals platform is cannibalization.
Oh, absolutely.
Because if a customer who usually buys a premium $10 combo meal realizes they can get 46 grams of protein for $8, they trade down.
Traffic might stabilize, but average check size drops, which further compresses those already fragile margins.
So to offset that risk, management is leaning heavily on their third pillar supply chain relief.
They are projecting that the double-digit beef inflation will cool significantly in the second half of the year, dropping to low single digits.
Because they will be lapping the historically high prices of the previous year. If the spot market price of a beef patty drops, the unit economics of that $8 bundle suddenly become viable.
Okay, that economic thesis makes sense on paper. But the fourth pillar of their turnaround strategy is what completely shatters the illusion of this flat growth projection.
Yes.
It is a piece of corporate financial engineering that every retail investor needs to understand. It completely changes the context of the numbers. Catalyst 4 is the accounting phantom of the 53rd week.
This is such a wild structural quirk of the retail reporting calendar.
Walk us through it.
So, to ensure that holidays align and year-over-year comparisons are somewhat standardized, many retail and restaurant corporations utilize a 4-4-5 accounting calendar.
Right.
A fiscal quarter is divided into 2 4-week months and 1 5-week month, totaling exactly 13 weeks.
Okay, so 4 quarters of 13 weeks equals 52 weeks, or 364 days.
Exactly. But because the actual Gregorian calendar has 365 days, or 366 in a leap year, the corporate calendar slowly falls out of sync with reality.
So to fix that drift, every 5 or 6 years, the company must insert an artificial 53rd week into their fiscal fourth quarter.
And 2026 just happens to be that magical 53rd week year for Wendy's.
The implications for their guidance here are just profound. When management promises Wall Street that global system-wide sales will be flat for the year, they are factoring in 7 entirely extra days of revenue in December that did not exist in the prior fiscal year.
They have an extra week to run the cash registers, sell Biggie Deals, and pad the final number.
This is the ultimate aha moment for anyone reading this earnings transcript. They aren't predicting a massive consumer renaissance to offset the Q1 disaster.
No, they are relying on a calendar loophole.
They are hiding a negative organic growth year behind an accounting phantom. If you strip out the revenue generated by that 53rd week, their true comparable growth for the year remains negative.
And the fact that they still only project flat growth, even with an extra week of sales, exposes just how weak the underlying momentum truly is.
Which brings us to section 4, the bottom line. That underlying weakness leads directly to the most critical yet under-discussed element of this entire report.
The financial health of the franchisees.
Wendy's operates an asset-light model. Corporate owns only a tiny fraction of the physical restaurants.
The vast majority are owned and operated by independent franchisees who pay rent, marketing fees, and royalties back to the mothership.
So the corporate balance sheet can look perfectly healthy while the franchise ecosystem collapses underneath it.
And the chief accounting officer delivered some terrifying data regarding the franchisees.
Yeah, in 2025, U.S. franchisees experienced an average net sales decline of roughly 6%.
But the lethal metric is the profitability. Their average EBITDA margins collapsed by 270 basis points, landing at an abysmal 9.3%.
A 9.3% EBITDA margin for a restaurant operator is the absolute danger zone.
After paying rent, servicing debt on the building, and paying corporate royalties, there is virtually zero free cash flow left for reinvestment.
And yet, Project Fresh relies entirely on these exact same strained mom-and-pop operators spending money to execute the turnaround.
Corporate is demanding that franchisees invest in new menu label printers, allocate labor hours to white glove cleaning protocols, and absorb the margin hit of selling an $8 Biggie bundle loaded with expensive beef.
You have a corporate entity demanding elevated capital-intensive standards from operators who are literally watching their profits evaporate.
An Evercore analyst practically cornered the CEO on this point. They asked if corporate would need to step in with a massive capital infusion just to keep the franchise base solvent.
And the CEO dodged the premise. He suggested that the strategic closure of unprofitable breakfast hours was their way of protecting franchise cash flow.
But stopping the bleeding doesn't magically generate the capital needed to buy new equipment or remodel a dining room.
If the franchisees hit a liquidity crisis, the entire turnaround stalls. They simply won't have the cash to execute the playbook.
That tension is the core risk of holding this equity. We have to provide a verdict based on the data. And looking at the near-term mechanics, the outlook has to be bearish to neutral.
The structural headwinds, double-digit beef inflation, a squeezed lower-income consumer, and franchisee margin compression are overwhelming the micro-operational wins of sticker printers and cleaner floors.
However, the neutral counterweight is the sheer cash generation of the brand.
Right. Despite the operational chaos, the company ended the quarter with $338 million in cash.
They're sustaining an attractive 14 cents per share quarterly dividend, which provides a solid floor for the stock.
And the aggressive 1,000 store expansion into China provides a long-term growth narrative that institutional investors can point to when justifying their positions.
It is the definition of a show-me stock. The data proving a turnaround simply isn't in the transcript yet. It's only promises of future execution.
So for you, the investor, holding the stock for capital appreciation requires an immense amount of faith. Faith that management can perfectly execute a highly complex transition in the second half of the year.
They must flawlessly integrate a new media agency, achieve massive volume on thin-margin Biggie Deals, and navigate a volatile commodities market.
All while relying on fatigued, financially stressed franchisees to carry the burden. If even one of those pillars cracks, if beef prices stay high, or the new ad agency fails to connect, or the 53rd week doesn't generate the expected artificial bump,
that flat guidance will evaporate.
and Wall Street will correct the valuation aggressively. Management is asking for your patience, and they are paying you a 14-cent dividend to wait, but the structural risks are severe.
The earnings call really is a masterclass in narrative control, but the underlying mechanics reveal a brand fighting a multi-front war against inflation, competitor discounting, and internal franchisee fatigue.
We have decoded the corporate spin, analyzed the supply chain friction, and exposed the accounting illusions hiding within the guidance. As we wrap up this deep dive into the Wendy's Q1 report, I want to leave you with one final thought.
Something to ponder on your own.
Exactly. We spent this entire time analyzing how Wendy's is trying to fix its internal machinery. Better labels, cleaner floors, slightly cheaper bundles. Management is banking everything on the premise that executing these basics will win back the consumer.
But look at the sheer weight of the macroeconomic environment.
If relentless inflation, exhausted credit lines, and the rising cost of living mean that the total pool of discretionary fast food spending is fundamentally shrinking, is possessing the highest quality fresh hamburger actually enough to steal market share? Or, in a tightening economy, is operational excellence simply the bare minimum required to survive?
That is the multi-billion-dollar question lingering over the entire quick service sector.
Until next time.